The $500K IRA trap, stealing your kids' inheritance. Your IRA could quietly hand your kids a tax bomb. Not because they did anything wrong, because the rules changed and compress everything into a narrow window. In the next few minutes, I'll show you the exact moves to avoid that trap and keep more money in the family. You'll learn what changed, who's at risk, and the sequence to fix it. There's one move that can turn a potential 40% hit into almost nothing. Don't miss it. Quick context first so the fixes land, then we jump straight into practical steps you can use today. Why this matters now: the rule change that flipped inheritance planning. For years, people planned around the stretch IRA. The idea was simple. If your adult child inherited your traditional IRA, they could take tiny required minimum distributions based on their life expectancy, often 40+ years, keeping taxes low and manageable. That world mostly ended with the Secure Act, effective for deaths after 2019 and later clarified by IRS guidance. The stretch survived only for a narrow group the law calls eligible designated beneficiaries: surviving spouses, minor children of the account owner until majority, disabled or chronically ill individuals, and beneficiaries not more than 10 years younger than the decedent. For most adult children, the stretch is gone. What replaced it is the 10-year rule. If your non-spouse, non-EDB heir inherits your traditional IRA, that account generally must be emptied by December 31 of the 10th year after your death. No new deduction, no special break. Every dollar they withdraw is ordinary income stacked on top of their salary, bonuses, RSUs, business income, rental income, everything. The clock is fast, the window is tight, and the tax brackets don't care that this is inheritance money. There's another wrinkle many families miss. If you die on or after your required beginning date for RMDs under current law, that's tied to the newer RMD ages from the Secure 2. Changes proposed: IRS guidance expects annual distributions in years 1 through 9, plus full depletion by year 10. Translation: your child may not be allowed to wait until year 10 and yank it all. They could be forced to take money out each year and still finish by the end of year 10. Even when annual distributions aren't required, the 10-year deadline remains. Either way, the time compression is the killer. Why is this such a problem? Bracket stacking. Most adult children inherit during peak earning years. Add $30,000, $50,000, or $100,000 of inherited IRA withdrawals onto a high W-2, toss in a bonus and some capital gains, and they're suddenly in a higher federal bracket, plus potentially the 3.8% net investment income tax if modified AGI crosses that threshold, plus state income tax if they live in places like California or New York. It's common to see effective taxes on those inherited IRA dollars land between roughly 25% and 45% when you add everything up. In high-tax states and high-income years, the bite can be larger. And then there's IRMAA, the Medicare Income-Related Monthly Adjustment Amount. It's a surcharge on Part B and Part D premiums based on a 2-year lookback of modified AGI. Cross a tier by $1 and you pay the full surcharge for that year. If your beneficiary is already on Medicare, their withdrawals today can raise premiums 2 years later. If they're 63 and not yet on Medicare, withdrawals at 63 and 64 can set ugly premiums for ages 65 and 66. That's a stealth cost that shows up after the tax season is long over. Account type matters more than most people realize. Traditional IRA dollars are pre-tax and fully taxable when withdrawn by heirs. Brokerage assets currently receive a step-up in basis at death, so future capital gains start from that new higher basis. Roth IRAs, heirs still face the 10-year depletion, but qualified withdrawals are tax-free, so there's no bracket stacking from the Roth dollars themselves. Leaving what to who changes everything about the tax outcome. Trusts can complicate or solve problems depending on how they're drafted. Conduit trusts force inherited IRA distributions straight out to the beneficiary each year, which under the 10-year regime can push income into bad years. Accumulation trusts can hold distributions for protection, but trust tax brackets are compressed, so retained income can hit top rates at low dollar amounts unless the trustee uses bracket-aware distributions and the 65-day rule to push income out in smarter years. The right drafting gives optionality, the wrong drafting locks in pain. Some families assume life insurance is a universal fix. It can create liquidity and equalize inheritances, but it doesn't solve the sequence risk of a big pre-tax pile unless it's integrated with conversions, beneficiary design, and a year-by-year withdrawal map. And no, beneficiaries can't use qualified charitable distributions from inherited IRAs to cut their own tax bill. QCDs are a lifetime tool for the original owner aged 70 and a half or older. If you're charitable, that lever belongs in your plan now, not in your child's plan later. Here's the bottom line. The Secure Act took away default lifetime stretching for most adult children and replaced it with a 10-year calendar problem. That compresses income into years your heirs can least afford a spike. The solution is to pull income forward into years you control. When rates are lower, think Roth Conversions in your gap years, using QCDs after age 70.5 to reduce pre-tax balances without lifting AGI, matching beneficiaries by tax bracket and state residency. And where control is needed, using trusts drafted for flexibility, not rigid payout rules from a pre-secure era. If you remember nothing else, remember this. You can't change that your heirs must empty the account by year 10, but you can change how much pre-tax they inherit and when taxes hit. Move pre-tax dollars in your low-rate windows. Leave tax-free or step-up assets for your heirs' high-rate windows. That's how you turn a tax bomb into a manageable plan. We'll quantify the damage next so you can see exactly what to fix and where the biggest wins are waiting. The pain in numbers, how the 10-year rule erodes inheritances. Let's make this real with numbers you can feel. Say a parent dies with a $500,000 traditional IRA. Their adult child earns $180,000 in W-2 income with a $20,000 bonus and occasional RSU vests. They live in a 9% state tax. Under the 10-year rule, that inherited IRA must be zero by December 31 of the 10th year after death. Every dollar withdrawn is ordinary income, stacked on top of what they already earn. Option 1, equal withdrawals. Pull $50,000 a year for 10 years. That $50,000 lands on top of $180,000 plus bonus, pushing the beneficiary deeper into the 24% or 32% federal bracket depending on filing status. Then add 9% state tax. If their modified AGI crosses the net investment income tax threshold, investment income gets hit with 3.8% too. After layering these, the effective tax on those IRA dollars commonly falls in the 28%, 38% range in higher tax states. Equal sounds simple. It's rarely optimal. Option 2, the year 10 dump. Assume the account grows modestly at 3.5% to about $700,000 by year 10. One big distribution lands in a peak earning year. That can push the marginal federal rate to the top bracket, tack on NIT exposure, and add full state tax. It's not unusual to see 40% plus effective tax on that distribution alone in high-income, high-tax scenarios. The cash hits the account. A huge slice goes straight to the IRS and the state. Option 3, bracket-aware sequencing. In years 1 and 2, the beneficiary's income dips, maybe a sabbatical or a slow year. They withdraw $100,000 each year during those lower brackets, then reduce to $30,000, $40,000 in high-income years. That front-loading can drag the effective tax on those IRA dollars into the mid-20s to low 30s, especially if they layer in itemized deductions, HSA contributions, or bunch charitable gifts. Sequencing isn't about perfection, it's about keeping income out of the worst years. State lines change everything. Two heirs with the same salary can have very different after-tax outcomes based purely on residency. A Florida resident with no state income tax may keep an extra 6%, 13% compared to a California or New York resident. If one heir expects to retire or relocate to a no-tax state in 3 years, holding withdrawals light now and accelerating post-move can save 5 figures on the same dollars. IRMAA sneaks in next. Suppose our beneficiary is 63. Pulling $50,000 at 63 and 64 sets their Medicare premiums at 65 and 66. IRMAA is a cliff. $1 over a threshold triggers the full annual surcharge. That $50,000 comfortable withdrawal can become an expensive 2-year premium spike. The smarter play might be $25,000 at 63 and 64 to stay under the tier, then larger withdrawals at 65, 66 after wages drop, still under the next cliff. Without an IRMAA map, you pay more than the tax software shows. Market behavior complicates timing but also creates chances. If the market drops 15% in year 4, harvesting a planned withdrawal then sells fewer dollars of value for the same cash, leaving more shares to rebound. If a rally lifts the account before a big RSU vest, you might pause the IRA withdrawal and use taxable assets with harvested losses to fund cash needs, keeping Magi in line. Don't try to call tops and bottoms, pair withdrawals with tax windows and use dips as convenient execution points. Let me give you 2 quick scenarios. A daughter at $190,000 income starts a 2-year MBA. She withdraws $90,000 per year during school, claiming available deductions and keeping under IRMAA tiers. Her effective tax on IRA dollars averages about the low 20s. Her brother waits until year 10 while earning $350,000 and liquidates the remainder at once. he clears 40% plus on that distribution. Same inheritance type, different sequence, night and day outcomes. Trusts add another layer. A conduit trust that must pass inherited IRA income out each year can force 50,000 plus distributions during high-income years, guaranteeing bracket stacking. An accumulation trust can hold income back, but trust tax brackets are compressed. Retained ordinary income hits top rates quickly. The fix is optionality, draft so the trustee can sprinkle distributions in beneficiaries' lower income years, use the 65-day rule to look back each January, and when protection is needed, feed the trust with Roth where possible so retained cash doesn't trigger trust-level tax. Here's a clean comparison for a $500,000 inherited traditional IRA. Intentional plan using low-income windows and state arbitrage. Effective tax 25%, 30%. Set it and forget it with equal withdrawals, 30%, 38%, often higher in RSU or bonus years. Year 10 lump in a high tax state and peak earnings, 40% plus on that final pull. And remember the silent losses, phase-outs and surtaxes. Higher AGI can phase out credits, trigger NIIT on investment income, and accelerate Social Security taxation. Even if you only see a 32% federal bracket, the add-ons make the real cost higher. The takeaway in numbers, timing beats hope. Map 10 years of income, guard IRMAA cliffs, respect state tax moves, and use market dips to execute planned withdrawals. Do that, and you turn a forced 10-year drain into a controlled, lower tax glide. Popular but risky moves most families try and why they fail. Let's walk through the moves that sound smart at the kitchen table but quietly blow up under the 10-year rule. First, we'll just take it all in year 10. It feels clean, no admin for 9 years, then done. But markets often grow, so the pile is bigger and your child may be at peak income then. That lump stacks on top of wages, bonuses, and capital gains, pushes them into higher brackets, may trigger the 3.8% net investment income tax and piles on state tax. In high-tax states, I routinely see 40% plus effective tax on that final year distribution. If they're near Medicare age, remember the 2-year IRMAA lookback. Year 10 income can spike premiums at 65 or 66. One decision, multiple hits. Next, equal annual withdrawals. 10 equal slices feels fair and low stress, but income isn't flat. RSUs vest, businesses swing, real estate sells. Equal withdrawals shove ordinary income into bad years and waste good ones. Without a year-by-year AGI map, equal often means drifting over IRMAA cliffs by a few $100s, triggering full-year surcharges or crossing NIIT thresholds that add 3.8% on top of investment income. The tax code punishes autopilot. Third, naming a trust with pre-secure conduit language. Conduit trusts must push out whatever the IRA pays each year. Under proposed guidance, when death is after the required beginning date, that can mean annual distributions in years 1 through 9 plus full depletion by year 10. That's rigidity at the worst time. Accumulation trusts fix the rigidity but create another trap, compress trust brackets. Retain too much and you hit top trust rates quickly plus state tax. The right answer is optionality, draft for accumulation but give the trustee discretion to distribute based on the beneficiary's bracket, residency, and Medicare status, and use the 65-day rule to fine-tune after year-end. Fourth, life insurance will solve it. Insurance creates liquidity and can equalize inheritances, but it doesn't change the fact that a large traditional IRA must be emptied within 10 years. If the pre-tax pile sits untouched and then dumps into a peak year, you still get bracket stacking and IRMAA hits. Insurance works when it's part of a plan paired with Roth Conversions, tax-aware beneficiary design, and a withdrawal map, not as a standalone bandage. Fifth, trying to do qualified charitable distributions from inherited IRAs. Beneficiaries can't do QCDs. QCDs are only for the original owner or their spouse if they're the owner after age 70 and a half. Waiting for kids to donate from the IRA removes a powerful lever. If you're charitable, use QCDs during life to shrink pre-tax without lifting AGI, and name a charity or donor-advised fund as a beneficiary of a slice of traditional IRAs at death. That wipes the tax the kids would have paid. Sixth, betting on the kid's future lower tax rate. She might step back in a few years. Maybe, or she gets promoted, her company is acquired, or she moves to a higher tax state. 10 years is a short window. Plans built on hope often end with year 10 panic. Build optionality instead, multiple inherited IRAs, flexible percentages, and a written year-by-year map so withdrawals can pivot fast when real life shows up. Seventh, ignoring state taxes and residency timing. Equal pre-tax slices to a California child and a Florida child are not equal after tax. If one heir will move to a no-tax state in 3 years, it can be worth keeping distributions light now and accelerating post-move. The difference is often 6%, 13% on the same dollars. Families miss this arbitrage because they don't coordinate inheritance plans with relocation timelines. 8th, letting the estate be the default beneficiary. That can shorten payout options, trigger probate, complicate administration, and reduce flexibility under the 10-year framework. It also blocks clean percentage splits to multiple heirs or charities. Name individuals, trusts, or charities directly on the beneficiary form. The form controls, not the will. 9th, treating Roth, traditional, and brokerage as interchangeable. Pro rata splits feel fair, but they're not fair after tax. High bracket heirs should get Roth, lower bracket heirs or charity should get traditional. Brokerage with step-up is your flexible equalizer. If protection is needed, consider sending Roth to the trust so accumulated cash doesn't incur trust-level tax, and leave traditional to lower tax individuals or charity. Finally, converting to Roth without an IRMAA or state tax map. Big conversions 2 years before Medicare can raise premiums, and converting right before moving from a no-tax state to a high-tax state backfires. The fix: choose a bracket ceiling to fill, often the top of the 22% or 24%. Check IRMAA tiers and schedule larger conversions in low or no-tax states. Fund the tax from taxable assets so every converted dollar lands in Roth. The pattern is the same. Simple rules of thumb fail because they ignore timing. The 10-year rule is a calendar problem. Without a calendar-first plan, these easy moves make taxes higher, premiums steeper, and options fewer. The control levers you actually have before you pass. If the 10-year rule compresses your kids' taxes, your job is to decompress them while you still control the calendar. You've got 6 levers that move the needle: asset location, Roth conversion timing, filing status awareness, RMD coordination, beneficiary design, and charitable alignment. Use them together and you turn a forced countdown into a planned glide path. Start with asset location. Don't spread everything evenly. Traditional IRAs are fully taxable to heirs. Brokerage gets a step up in basis at death under current law, so future capital gains start from that new stepped-up number. Roth IRAs are tax-free to beneficiaries if the 5-year rule is satisfied, though they still must drain within 10 years. So here's the alignment. Put tax-inefficient, slower-growth assets like taxable bonds or REITs inside pre-tax accounts. Keep tax-efficient, higher-upside assets in brokerage to maximize the step-up, and reserve Roth space for your highest-growth holdings. The reason this works is you're matching asset behavior to how each account is taxed across generations. Now Roth conversions, the biggest lever. You're swapping your known tax rate now for your heirs' likely higher rate later. Best windows: gap years after retirement but before Social Security and required minimum distributions kick in, unusually low income years, and down markets where converting the same number of shares creates less taxable income and more upside compounding inside Roth. Don't chase zero tax. Fill your current bracket on purpose, often up to the top of the 12%, 22%, or 24% brackets if your kids will face 32% or higher on inherited withdrawals. Fund the tax from taxable assets so every converted dollar lands in Roth and keeps compounding tax-free. Before you continue, map Medicare's IRMAA tiers. Conversions lift modified AGI and can increase Part B and D premiums 2 years later. That doesn't mean don't convert. It means avoid crossing big cliffs unless the trade is clearly worth it. Build a simple one-page grid of IRMAA thresholds for your filing status. If a life-changing event drops income, retirement, marriage, divorce, death, you can appeal with Form SSA 44 to reduce surcharges. Also consider state tax arbitrage. If you'll move from a high tax to a no tax state soon, delay large conversions until after the move. If you're in a no tax state now and might relocate to a higher tax state later, accelerate conversions while they're cheaper. Filing status is the silent tax hike. After the first spouse dies, the survivor loses married filing joint brackets and faces the widow's penalty. Same income, tighter brackets. That's why aggressive conversions often make the most sense between retirement and the first death, and again in the year of death when the survivor can still file jointly. Coordinate Social Security timing here. Delaying benefits can keep AGI lower in those heavy conversion years and boosts the survivor benefit later. RMD coordination prevents your own bracket creep. If pre-tax balances grow unchecked, future RMDs inflate your taxable income and crowd out conversion room. You can make strategic pre-RMD withdrawals to trim the base. If you're 70.5 or older and charitable, use qualified charitable distributions to satisfy part or all of your RMD without raising AGI. That helps with IRMAA and frees up space for Roth conversions in the same bracket. The benefit is you're moving money out of pre-tax without lifting the AGI line that drives surcharges and phase-outs. Beneficiary design is where planning meets family reality. Equal after-tax beats equal by percentage. High bracket heirs should get more Roth, lower bracket heirs or charity should get more traditional. Brokerage bridges both. Use multiple IRAs to make execution clean, one IRA per heir or trust, so each inherited account can be managed to that person's 10-year map. Keep forms updated with primaries, contingents, and per-stirp so shares flow where you intend if life changes. If a trust is needed for control or protection, draft for accumulation with discretionary distributions keyed to the beneficiary's bracket, residency, and Medicare status, and allow use of the 65-day rule. Charitable alignment erases the worst tax dollars. During life, QCDs at 70.5 and beyond reduce pre-tax balances and keep AGI down. At death, name a charity or donor-advised fund as a percentage beneficiary of traditional IRAs. Send the fully taxable dollars to an entity that pays no income tax and reserve Roth and step-up assets for family. If you want income to an heir and a remainder to charity, consider a testamentary charitable remainder trust funded with traditional IRA dollars. It can provide stretch-like payouts and shift the ultimate tax burden away from your kids. Let me tie this into a simple action sequence. 1. Inventory accounts by type and decide what belongs where: pre-tax for tax-inefficient assets, brokerage for step-up, Roth for growth. 2. Pick a bracket ceiling and schedule conversions in 2 or 3 tranches through the year, pausing if other income spikes. 3. Map IRMAA tiers and state tax plans. Choose which cliffs you'll avoid and which you'll cross on purpose. 4. Update beneficiary forms with tax-aware splits and open separate IRAs if needed. 5. If charitable, set QCDs and designate a DAF or charity as a slice of traditional IRAs. 6. Write a 1-page 10-year map per heir with bracket and IRMAA guardrails. The throughline is control over timing. You can't change the 10-year deadline for your heirs, but you can shrink the pre-tax pile, redirect the worst taxed dollars, and hand them accounts that don't blow up their AGI. That's how you keep more in the family on purpose. Lever 1. Strategic Roth conversions without regret. Roth conversions are the cleanest way to diffuse the 10-year squeeze for your kids, because you swap your known tax rate now for their likely higher one later. Done right, you shift future income out of your heirs' peak years and into your own gap years, and you do it without tripping avoidable cliffs like IRMAA or ugly state taxes. The playbook is timing, brackets, funding, and guardrails. Why this matters for heirs under the Secure Act is simple. Non-spouse, non-EDB heirs must empty inherited IRAs by December 31 of the 10th year after death. If the account is Roth and the owner satisfied the 5-year clock, your heirs still face the 10-year depletion, but their withdrawals are tax-free. No bracket stacking on top of wages. No 3.8% net investment income tax on those Roth dollars. Far less IRMAA risk. You've traded their compressed ordinary income for your planned conversion income. Your best conversion windows are the cheap tax years. Think after you retire and before Social Security and required minimum distributions start, any unusually low income year, and market drawdowns where converting the same number of shares creates less taxable income and leaves the rebound inside Roth. Don't chase zero tax. Fill your current bracket on purpose. For many retirees, the top of the 12%, 22%, or 24% marginal bracket is the sweet spot, especially if your heirs will pay 32% or 35% plus on inherited traditional IRA withdrawals layered onto high W-2 income and state tax. Here's exactly how to pick your annual target. First, project this year's adjusted gross income without any conversion. Second, choose a bracket ceiling you're comfortable filling, say the top of the 22% or 24% bracket. Third, subtract your projected AGI from that ceiling. The result is your conversion room. Fourth, overlay Medicare IRMAA tiers with the 2-year lookback. If a $5,000 bump would cross a cliff, either trim the conversion just under the line or decide the surcharge is worth it to remove future pre-tax. Fifth, sanity check state taxes and any credits or deductions that phase out as AGI rises. Then execute conversions in 2 or 3 tranches through the year so you can pause if other income surprises. IRMAA mistakes are common but avoidable. Conversions increase modified AGI and can raise Part B and D premiums 2 calendar years later. IRMAA tiers are cliffs. $1 over triggers the full annual surcharge. That's why bracket ceilings and IRMAA lines should both sit on your 1-page converter's dashboard. If you retire, divorce, marry, or a spouse dies, events that lower income, you can file Form SSA 44 to ask Social Security to base premiums on your new income. Use that when a one-time spike otherwise lingers. State tax arbitrage is free money when you can get it. If you'll move from a high-tax state to a no-tax state like Florida or Texas next year, delay larger conversions until after residency flips. If the reverse is true, you're in a no-tax state now but might move to a higher tax state, accelerate conversions while they're cheaper. The difference on six-figure conversions is often 6%, 13% of the amount converted, purely from zip code. Funding the tax the right way protects compounding. Pay the conversion tax from taxable cash or by selling high-basis assets in brokerage. Don't withhold taxes from the conversion itself unless you must. Withholding shrinks the dollars that make it into the Roth, and if you're under 59.5, it can trigger penalties on the withheld portion treated as a distribution. The goal is maximum Roth dollars growing tax-free. Now the gotchas. Converting too much too fast can push you into a higher marginal bracket that doesn't beat your heirs' likely rate. Converting in the same year you realize large capital gains in taxable can drag you into the NIIT zone unnecessarily. Converting blindly at 63 and 64 without checking IRMAA sets expensive premiums at 65 and 66. Ignoring the widow's penalty leaves cheap joint brackets on the table. After the first spouse dies, the survivor files single and hits higher brackets sooner on the same income. Coordinate Social Security timing. 2 more AGI pulls more of your benefits into taxation, which can crowd out conversion room if you start benefits early. Let me give you a simple template you can use this week. Print a one-page grid with 4 lines, projected AGI, chosen bracket ceiling, next IRMAA tier and conversion room. Fill it for this year and next year. Add notes, appeal IRMAA if retirement in year, delay large conversion until Florida move in June, 2 tranches, spring and fall, add small third if market dips 10%. Then run a mock tax return with a $50,000 conversion layered in and watch which thresholds move. Adjust your ceiling until the trade-offs feel right. One quick micro story. A widower retired at 66 with a $1.1 million traditional IRA and modest pensions. He delayed Social Security, built a conversion ladder filling the 22% and part of the 24% bracket for 4 years, and accepted one IRMAA Tier 1 year to clear more pre-tax. He funded taxes from high-basis brokerage. By his RMD age, the pre-tax base was trimmed, his Roth was larger, and his kids now face a much lighter 10-year squeeze, mostly tax-free distributions instead of bracket spikes. The reason this works is timing. The Secure Act compressed your kids' tax window. Roth conversions let you decompress it by moving taxable income into years you choose at rates you accept under cliffs you control. That's how you convert without regret. Lever 2, trusts that don't sabotage your kids' tax bill. Trusts give you control, but under the Secure Act's 10-year rule, they can also wreck the tax plan if they're drafted the old way. So let's make them work for you, not against you. Start with the 2 big flavors. A conduit trust says whatever the IRA pays to the trust must be paid straight to the beneficiary that same year. Under the old stretch, that was fine. Small RMDs trickled out over decades. Under today's 10-year regime, it can force big distributions in bad tax years. And if you die on or after your required beginning date for RMDs, current IRS guidance expects annual distributions in years 1 through 9 plus full depletion by year 10. A conduit structure in that scenario practically guarantees bracket stacking and can even push beneficiaries over IRMAA cliffs. An accumulation trust is the opposite. It allows the trustee to hold IRA distributions inside the trust for protection, great for minors, second marriages, creditor risk, or a beneficiary who shouldn't get cash all at once. The catch: trust tax brackets are compressed. Retained ordinary income hits the top federal rate at low dollar amounts compared to individuals, and state trust taxes can pile on. If the trustee routinely accumulates income, the trust can pay more tax than the beneficiary would have paid, burning dollars you meant to preserve. So the game changer is optionality. Draft for accumulation, but give the trustee broad discretion to distribute when it's tax smart. Include language that explicitly instructs the trustee to consider each beneficiary's marginal bracket, residency, and Medicare status when deciding distributions. Build in the power to sprinkle income among multiple beneficiaries if that lowers total tax. And authorize use of the 65-day rule. The trustee can distribute trust income within the first 65 days of the following year and have it treated as paid in the prior year. That short hindsight window lets you tweak after bonuses, RSU vests, or business income land. Before we continue, you need to understand separate shares. If multiple beneficiaries share a single trust, you want separate share provisions so each person's inherited IRA and tax plan can run independently. Better yet, create multiple IRAs during life and name one trust beneficiary per account. Custodians administer cleaner when each inherited IRA matches one trust share, and the trustee gets freedom to tailor withdrawals to one person's 10-year calendar without hurting the others. Now let me show you exactly how to pair trusts with account types. If protection is the goal, consider directing Roth assets to the trust and traditional assets to lower tax heirs or charity. Accumulating Roth distributions doesn't create taxable income inside the trust, so you keep control without paying trust-level ordinary rates. If traditional IRA dollars must flow to a trust, plan scheduled discretionary payouts in the beneficiary's lower-income years, sabbaticals, early retirement, or post-relocation to a no-tax state, so the income is recognized where the rate is lowest. Drafting checkpoints for your attorney. Accumulation permitted with full discretionary distributions, not conduit only. Standards that let the trustee weigh bracket, state residency, and IRMAA implications. 65-day rule authority and a requirement to keep tax calendars. Separate share provisions so each beneficiary's 10-year plan is independent. Charitable carve-outs from pre-tax dollars if that aligns with your intent. Appointment of a trust protector to adjust distribution standards as tax laws change. Common mistakes to avoid. Copying pre-secure conduit language that hardwires annual payout, naming your estate as IRA beneficiary and then funneling to a trust, messy timelines, fewer options, choosing accumulation but never distributing, letting income pile up at trust top rates, ignoring state trust taxation, which can surprise you if the trustee or trust situs is in a high-tax state. And failing to coordinate a trust's withdrawal plan with the beneficiary's IRMAA map, accidentally triggering premium surcharges 2 years later. Here's a quick micro story. Parent left a traditional IRA to conduit trust for a 28-year-old son who worked in tech with volatile RSU vesting. Because the decedent died after their required beginning date, the conduit had to pass out annual IRA distributions in years 1 through 9. In 2 RSU-heavy years, those forced payouts pushed the son into a higher federal bracket and over an IRMAA tier later when he hit Medicare. Same family, same balance, but the wrong document language removed all flexibility. They could have avoided it with an accumulation trust plus bracket-aware standards and 65-day authority. Implementation flow that works. During life, decide which beneficiaries actually need trust protection. Only route those slices through a trust. Align account type Roth to trust when possible, traditional to lower tax heirs or charity. At death, the trustee immediately retitles to an inherited IRA in the decedent's name for the trust's benefit and builds a 10-year calendar that mirrors the beneficiary's income map. Each fall, the trustee reviews wages, bonuses, capital gains, IRMAA thresholds, and state residency, then decides whether to distribute by December 31 or use the 65-day window to fine-tune. Document every decision with a short memo. Bracket target, IRMAA tier, and why keeping or distributing minimizes lifetime tax. If you remember nothing else here, remember this. Trusts are about control, taxes are about timing. In a 10-year world, the best trust is flexible, able to hold when protection matters, and able to release income when the beneficiary's bracket, state, and Medicare status make it cheap. Draft for that discretion, align the right assets to the trust, and put a calendar in the trustee's hands. That's how you protect your heirs without handing the IRS a bigger slice. Lever 3, smart beneficiary design that lowers lifetime taxes. Beneficiary design is where tax math meets family fairness. Equal by percentage sounds right, but equal after tax is what actually feels fair when checks arrive. So let's match the asset type to each person's tax reality and remove the traps your kids don't see coming. Start with marginal rate and residency. A high bracket heir in California should not receive the same pre-tax slice as a moderate bracket heir in Texas. Aim traditional IRA dollars toward the lower tax heir or to charity and tilt Roth toward the high tax heir. Brokerage with step-up stays flexible for either. That one alignment can save 6%, 13% just from state differences, plus the federal bracket spread you avoid. Use multiple IRAs to make this clean. Instead of one large traditional IRA split 3 ways, create 3 IRAs and name one beneficiary on each. Now each inherited account can be managed to that person's 10-year calendar. Front load for the entrepreneur with lean years ahead. Slow roll for the W-2 earner. Accelerate after a move to a no-tax state. Custodians administer separate accounts far cleaner than trying to run 3 strategies inside one inherited IRA. Write down your after-tax fairness logic. If your daughter is a surgeon in a 37% bracket and your son is a teacher at 12%, send more Roth or step-up assets to her and more traditional to him. If you want dollar equality, adjust the percentages so their after-tax net lands closer. A one-page note in your legacy file prevents resentment later because it explains the math and the intent. Age and timing matter. A beneficiary near retirement may be perfect for pre-tax. They can drain during their early retirement gap years before Social Security and RMDs at modest rates. A younger, fast-rising earner benefits more from Roth since inherited Roth withdrawals won't stack on top of peak wages. Your design should reflect their next 10 years, not their last 10. For STRPs and contingents, keep assets flowing where you want. If a child predeceases you, do you want their share to pass to their kids or be reallocated to siblings? Set per STRPs if you want it to flow down the line. Always name contingent beneficiaries so the default isn't your estate. Pour over to an estate can shorten payout options and complicate administration under the 10-year rule. Coordinate with state moves. If a child will relocate from a high-tax state to a no-tax state in 3 years, you can design flexible percentages and add guidance to keep distributions minimal now and accelerate post-move. The same dollars can be worth 6%, 13% more just by crossing a border before taking income. Put a short instruction note in your legacy letter. Distribute more after residency change. If a trust is involved for only one beneficiary, say, a second marriage, minor children, creditor protection, or special needs planning, don't route every asset through it. Send Roth to the trust when possible so retained cash doesn't trigger trust-level ordinary income, and direct traditional IRA dollars to lower tax heirs or charity. If traditional must go to a trust, draft for discretionary distributions keyed to the beneficiary's bracket, residency, and IRMAA tiers, and authorize the 65-day rule so the trustee can fine-tune after year-end. Integrate charitable intent. If you plan to give 10%, 20% of your estate, make that percentage a beneficiary on your traditional IRA, not your Roth or brokerage. The charity pays no income tax, your kids inherit fewer pre-tax dollars, and you preserve tax-free and step-up assets for them. If you want a steady income stream to an heir with a remainder to charity, talk to your attorney about a testamentary charitable remainder trust funded with pre-tax dollars. It can mimic stretch-like payouts and redirect the ultimate tax burden away from your kids. Here's a simple blueprint you can execute this month. List each heir with current bracket band, likely bracket in 5 years, and state. Next to each, assign a preferred asset: Roth for high bracket, traditional for low bracket or charity, brokerage/step-up for flexibility. Open additional IRAs if needed and set one beneficiary per account to keep strategies separate. Update beneficiary forms with primaries, contingents, and per STRPs as desired. Draft a one-page 10-year map per heir, target bracket ceiling, next IRMAA tier, residency plans, and a default withdrawal cadence with notes like front load in low-income years or accelerate after Florida move. Common mistakes to avoid: pro rata splitting every account, giving Roth to the lowest tax heir and traditional to the highest. Routing pre-tax through a trust that must accumulate without bracket-aware discretion, leaving beneficiary forms stale, ignoring the widow's penalty for a spouse who will soon file single, and forgetting to pair the plan with IRMAA and relocation timing. A quick micro story. One family had 2 kids, a New York attorney and a Texas nurse. Instead of splitting a $900,000 traditional IRA and $400,000 Roth down the middle, they created 2 IRAs and tilted, more traditional to Texas, more Roth to New York, brokerage pro rata. They added a note explaining after-tax fairness and a 10-year map for each. The attorney avoided bracket stacking with tax-free Roth. The nurse used low-income summers to pull traditional. Same love, better net. The reason this works is simple. You're steering each dollar to the hands that tax it the least while matching the account type to each person's next decade. Do that and equal finally means equal where it counts, after tax. Stealth cost: how inherited IRAs trigger IRMAA and Medicare costs. Now let's tackle the quiet bill that blindsides a lot of families. Medicare's IRMAA. It's not a tax, but it behaves like one. IRMAA is a surcharge on Medicare Part B and Part D premiums based on your modified adjusted gross income with a 2-year look-back. Cross a tier by $1 and you owe the entire surcharge for that calendar year. That cliff structure is why inherited IRA withdrawals can sting long after tax season ends. Here's the core problem. Inherited IRA distributions are ordinary income to your beneficiary and they lift MAGI. If your child is already on Medicare, say age 67, withdrawals in 2025 set their 2027 premiums. If they're 63 when they inherit, withdrawals at 63 and 64 set their first 2 Medicare years at 65 and 66. A reasonable $40,000 pull can quietly push them over a tier, and the premium hit won't show up until 2 years later when it's too late to fix. But what do pros do differently? They run a 2-year rolling MAGI map alongside the 10-year depletion plan. Start with a simple dashboard, projected MAGI for this year and next, the next IRMAA threshold line, and a safe inherited IRA withdrawal that keeps MAGI just under the cliff. Update it every fall before year-end moves. If baseline income already sits near a tier, trim IRA withdrawals and fund spending from Roth or high-basis taxable assets instead. If a big withdrawal is unavoidable, maybe the clock's tight, bunch more into 1 year and keep the following year squeaky clean rather than peaking over multiple cliffs in back-to-back years. If your beneficiary isn't on Medicare yet, timing becomes your best lever. Ages 60 to 64 often include peak wages and also set the first 2 premium years at 65 and 66. 2 workable patterns: accelerate earlier, then taper at ages 63 and 64 to deliver clean look-back years, or wait and front-load right after retirement when wages drop, staying under the next cliff. Which one wins depends on their retirement date, RSU schedules, and whether they'll move to a lower tax state before Medicare. Coordination with other accounts is how you keep MAGI in bounds. Use inherited Roth for spending in IRMAA-sensitive years. Those withdrawals don't raise MAGI. In taxable, harvest losses when markets dip to offset gains and prefer selling high-basis lots for liquidity. Delay realizing large capital gains in the same year you take meaningful IRA income. If you must sell, consider pairing it with a lighter inherited IRA year to keep combined MAGI under the next threshold. Let's make it concrete. Your daughter is 63, earns $170,000, and inherits a $500,000 traditional IRA. Without a plan, she withdraws $50,000 at 63 and 64. Taxes rise, and 2 years later, premiums jump too. A better map: take $20,000 at 63 and 64 to stay under the cliff. Fill the gap with inherited Roth and taxable cash. Then after retiring at 65, take $110,000 at 65 and $90,000 at 66 while wages are gone, still steering under the next tier. Same 10-year deadline, less premium pain. Now here's where most people mess up. They forget about appeals. If a life-changing event cuts income, retirement, marriage, divorce, or the death of a spouse, your beneficiary can file Form SSA 44 and ask Social Security to base premiums on the new, lower income rather than the look-back year. That doesn't fix every scenario, but it's the right move when a one-time spike would otherwise haunt them for a full year. Common traps to avoid. Equal annual withdrawals that sit a few $100s over a threshold for multiple years. Stacking big capital gains with inherited IRA income in the same calendar year. Ignoring that a parent's late life Roth conversions can raise the parent's own IRMAA unless coordinated with brackets and appeals. Forgetting that QCDs reduce the owner's AGI and can open room for conversions without lifting IRMAA exposure. Quick win: build the 3-line IRMAA dashboard, projected MAGI, the next tier line, and the safe withdrawal number, and set a calendar reminder every October to refresh it. Pair that with a note: use Roth for spending in IRMAA years, delay taxable gains if IRA income is high. The reason this pays off is simple. The 10-year rule forces income somewhere. If you place it in years that don't blow through IRMAA cliffs and swap in Roth or high-basis taxable for cash flow when needed, you protect the inheritance twice. Lower taxes today and lower premiums 2 years from now. That's the difference between an avoidable surcharge and a smooth, predictable plan. Charitable strategies that erase the pre-tax problem cleanly. If you're charitable, this is the cleanest way to delete the worst tax dollars. You're redirecting income that would hit your child's top bracket to someone who pays 0 income tax. Done right, it simplifies your plan, trims your RMD base, and shrinks what your kids must drain in their 10-year window. Start with qualified charitable distributions during life. Once you're age 70.5, you can send up to the annual limit per year directly from your IRA to qualified charities. It counts toward your RMD when those begin, but it does not increase your adjusted gross income. That's the key. No AGI lift means fewer phase-outs, less IRMAA risk, and more room for bracket-filling Roth conversions. The thing most people miss is beneficiaries can't do QCDs from inherited IRAs. QCDs are your tool, not your kid's tool. If you're giving anyway, give from the account that's worse to leave to family. Next, move charity to the beneficiary form, not your will. If you plan to give 10%, 20% at death, name the charity or a donor-advised fund as a percentage beneficiary of your traditional IRA. The charity pays no income tax on those dollars. Your heirs receive fewer pre-tax assets and relatively more Roth and step-up brokerage. Same generosity, better tax alignment. Custodians handle percentage splits cleanly, and it avoids probate entanglement. Donor-advised funds add flexibility. Maybe you don't know exactly which nonprofits you want to support long-term, or you want your kids to participate in recommending grants. Name a DAF as a partial beneficiary of your traditional IRA. At death, that slice flows tax-free to the DAF. Your family can recommend grants over years, preserving your giving rhythm without forcing your kids to make lump sum choices right away. During life, you can also fund a DAF from taxable assets for a deduction in high-income years, while using QCDs from the IRA to keep AGI down. Two levers that work together. If control and income for heirs matter, consider a testamentary charitable remainder trust funded with traditional IRA dollars. Here's the idea. The IRA pays to the CRT at your death. The CRT makes annual payments to your chosen beneficiary for a term of years or life within IRS limits, and whatever remains goes to charity. The trust doesn't recognize the entire IRA as ordinary income all at once. Practically, you've recreated stretch like cash flow protected principle and sent the ultimate tax burden to a tax-exempt recipient. It's more complex and needs an attorney who builds CRTs, but for large IRAs and protection goals, it can be a strong fit. How big should the charitable slice be? Work backward from outcomes. If your kids will face an effective 32%, 40% on inherited traditional IRA dollars, decide how much of the IRA you want to remove from their 10-year pile. Some families pick a fixed percentage, say 15% to a DAF, and then tilt more Roth to the high earner child and more traditional to the lower earner child. Others calculate, we'll send enough pre-tax to charity so remaining IRA withdrawals fit inside our kids' target brackets. Both approaches work because they cap the forced ordinary income your heirs must recognize. Coordination makes this powerful. During life, use QCDs to satisfy part or all of your RMD without lifting AGI. That frees space for bracket-aware Roth conversions in the same year. At death, the IRA beneficiary form directs a set percentage to charity. Your heirs inherit more Roth and step-up assets and a smaller traditional balance that's easier to drain under the 10-year rule. If a trust is needed for control, consider routing Roth to the trust when possible so accumulated distributions don't trigger trust-level ordinary income. Leave traditional to lower tax heirs or to charity. Common mistakes to avoid. Leaving Roth to charity and pre-tax to kids, reverse it. Trying to do QCDs as a beneficiary, you can't. Naming your estate instead of a charity or DAF directly, you lose simplicity, and ignoring state tax and IRMAA coordination when pairing QCDs with conversions. Also, confirm your charities are qualified. QCDs must go to eligible organizations. Donor-advised funds aren't QCD recipients, though they can be IRA beneficiaries at death. Here's a quick action plan you can take this month. If you're 70.5 or older, set QCDs to cover part or all of your RMD. Run a mock return, watch AGI, IRMAA, and bracket room. Pick a Roth conversion ceiling you'll fill with the space QCDs opened. Update IRA beneficiary forms. Add a DAF or named charities for a percentage of traditional IRAs. Tilt Roth to the highest bracket heir and keep brokerage as your flexible equalizer. Write a 2-paragraph legacy note. Why charity gets pre-tax, why Roth tilts to the high earner, and how the 10-year maps work. The reason this strategy wins is simple. The Secure Act compresses your kid's tax window. Charity expands yours. By giving the worst tax dollars to someone who pays no tax and preserving tax-free and step-up assets for family, you protect the inheritance twice, less forced income for your heirs and more lasting impact from your giving. The 10-year playbook, withdrawal sequencing for beneficiaries. Let's turn this into a simple, repeatable playbook your heirs can use. The goal is to empty the inherited IRA by December 31 of year 10 while keeping modified AGI under painful tax and IRMAA cliffs, and pairing withdrawals with years that have lower income or bigger deductions. Start before year 1. Red idle the account correctly as an inherited IRA. Never roll it into your own IRA if you're a non-spouse. Confirm whether a year of death RMD is due and satisfy it from the inherited IRA by December 31. Then build a 10-year income map. List wages, bonuses, RSU schedules, business income, pensions, Social Security timing, known capital gains, and expected deductions. Overlay 3 guardrails for each year: your target top federal bracket, the next IRMAA tier line, and your state tax situation based on residency. Now decide your default cadence. Equal withdrawals are the fallback, not the plan. If you see low income windows, early sabbatical, grad school, launch of a business, front load. If a move to a no-tax state or retirement is coming in years 3 to 5, backload into those years. Write a default percent for each year so you can course correct without guessing. Use tranches, not one and dones. Execute 2 to 4 distributions per year. When markets dip 5%, 10%, take a tranche. You'll sell fewer dollars of value for the same cash. When the market rebounds or other income spikes, pause. You aren't timing the market, you're using dips as efficient execution points while you stay inside tax guardrails. Pair withdrawals with deductions. If you'll itemize heavily in a year, large charitable gifts, business equipment expensing, unusually high medical expenses, tilt more inherited IRA income into that year. For business owners, combine inherited IRA withdrawals with Section 179 or bonus depreciation years. For investors, harvest losses in taxable to offset gains while taking IRA income. Manage IRMAA with a 2-year lens. Build a tiny dashboard for this year and next. Projected MAGI, the next IRMAA tier, and the safe, inherited IRA withdrawal that keeps you below the cliff. If your baseline income already sits near a tier, trim the inherited IRA pool and fund spending from Roth or high-basis taxable assets. If a big withdrawal is unavoidable, bunch more into 1 year and keep the following year clean, rather than peaking over multiple tiers in back-to-back years. Coordinate with other accounts. Use inherited Roth for spending in IRMAA-sensitive years. Those dollars don't raise MAGI. In taxable, prefer selling high-basis lots and harvest losses when available. Delay realizing large capital gains in heavy inherited IRA years or offset them with harvested losses. The reason this works is you're smoothing total MAGI, not just the inherited IRA line. Build the first 3 years deliberately. Start with a modest default, often 8%, 12% of the starting inherited IRA balance in year 1. Adjust up if income drops, down if RSUs or bonuses surprise. Keep a running tally of what's left against the 10-year total. Each fall, refresh your estimates and rewrite next year's defaults. Years 4 to 6 are your pivot. If a state move is imminent, keep distributions minimal before residency flips, then accelerate after. If retirement starts, stack larger withdrawals in the first 2 wage-free years while you steer under the next IRMAA cliff. Always confirm whether any proposed IRS annual distribution rules apply based on the decedent's RMD status. If annual payouts are required, meet them early in the year and use your remaining flexibility with taxable and Roth. Years 7 to 9 are cleanup. Compare the remaining balance to your remaining bracket capacity. If you're behind, consider 2 larger distributions in 1 calendar year. If you can still stay under a reasonable bracket and IRMAA tier, then keep the next year light. If you're ahead, glide with smaller withdrawals and let markets work. Keep flexibility. Jobs change, RSUs shift, tax laws update. Year 10 is not for procrastination. Start the year knowing exactly how much remains and how you'll zero it by December 31 without shredding multiple cliffs. If you're forced into a sacrifice year, cross 1 IRMAA tier decisively and keep the next year clean rather than nicking 2 tiers lightly. If a surprise job loss or retirement happens, seize the window and finish early. 2 quick patterns you can copy. High earner, age 63, retiring at 65. Take 5%, 7% at 63 and 64 to stay under IRMAA. Fund extra spending from Roth, then 15%, 20% at 65 and 66 after wages drop, and right-size years 7 through 9 with a small final cleanup. Business owner with volatile profit. Take 0 in a blowout year and double up the next year when deductions or a lean profit reduce taxable income. Review quarterly with a CPA, not just in December. Document everything in plain English. 1 page, the 10-year map, your bracket ceiling, next IRMAA tier, state residency notes, and default withdrawals by year with a sentence explaining why. Add a reminder to file Form SSA 44 if a life-changing event lowers income and could reduce IRMAA. If you remember nothing else, remember this: the 10-year rule is a calendar problem. Map the calendar first, then drop income into the cheapest years. That's how beneficiaries keep more of what you meant them to have. Case studies, different families, different best answers. Let's run through a few real-world styles so you can see how the same rules point to different best moves. High-earning child in a high-tax state versus lower-earning sibling. Mom leaves a $900,000 traditional IRA and a $400,000 Roth. Daughter's a surgeon in California, top bracket. Son's a teacher in Texas, modest bracket. Equal pro rata sounds fair, but after tax it's not. Better, split accounts. Create IRA A payable to the teacher and IRA B payable to the surgeon. Tilt more traditional to the teacher, more Roth to the surgeon, and leave brokerage pro rata for flexibility. The teacher front-loads withdrawals in summers when income dips and keeps an eye on Medicare IRMAA later. The surgeon uses the inherited Roth without stacking ordinary income on peak wages. Mom documents equal after-tax logic in a 1-page note. Same love, less tax. Widow with large IRA and gap years, convert aggressively. Carol, 66, recently widowed, has a $1.2 million traditional IRA, $250,000 Roth, and $500,000 brokerage. She delays Social Security to age 70. These are premium conversion years. She fills the 22% and much of the 24% brackets annually, funding tax from high basis taxable assets. She watches IRMAA with a 2-year look-back and accepts 1 surcharge year to clear bigger pre-tax. At her RMD age under current law, the base is trimmed. Her kids inherit more Roth and a smaller traditional pile, easing their 10-year clock. Blended family, trust for spouse, direct to kids. Dan wants income for his second spouse, Mia, but the remainder to his adult kids. He points a slice of the traditional IRA to an accumulation trust for Mia, drafted with discretionary distributions keyed to her bracket, residency, and IRMAA tiers, plus 65-day authority. Roth and brokerage go outright to the kids. He also names a donor-advised fund for 10% of the traditional IRA on the beneficiary form. Result: protection for Mia, lower trust-level tax by distributing in her low-income years, lighter 10-year burden for the kids, and clean charitable impact from pre-tax dollars. Business owner beneficiary with volatile income, opportunistic withdrawals. Priya inherits $600,000 in a traditional IRA and runs a business with swings, sometimes using Section 179. She builds a 10-year map that pairs big withdrawals with low profit or high deduction years. In boom years, she takes minimal or zero. In lean years, she doubles up distributions while staying under NIIT and IRMAA tiers. She reviews quarterly with her CPA, not just in December, and executes in 2 to 3 tranches using market dips to sell fewer dollars of value for the same cash. Charitably inclined couple, pre-tax to DAF, Roth to kids. Sam and Leela want to give 15% of their estate. They designate 15% of the traditional IRA to a donor-advised fund at death and tilt Roth toward their high-earning daughter. During life, they use qualified charitable distributions after age 70.5 to cover RMDs without lifting AGI, which frees room to fill the 22% bracket with conversions. At death, the DAF receives its slice tax-free, the kids get more Roth and step-up assets, and the remaining traditional balance is manageable inside the 10-year window. Non-spouse minor child, special rules. Alex dies at 58, leaving a $400,000 IRA to his 12-year-old son, Ethan. Ethan qualifies as an eligible designated beneficiary, so a stretch is allowed until majority, then the 10-year clock starts. Alex named a flexible accumulation trust. The trustee accumulates for protection, but uses discretionary payouts during low-income summers to keep trust-level tax minimal, then steps distributions once Ethan turns majority to avoid a year 10 pile-up. If scholarships reduce need, the trustee retains more in high-income years and releases income when Ethan's W-2 is small. 2 siblings, relocation timing. They split pre-tax equally, but one plans to retire to Florida in 3 years. Their maps diverge. The staying sibling takes more early to keep under brackets and IRMAA. The moving sibling keeps withdrawals light pre-move, then accelerates after residency flips to capture state tax arbitrage. The family documents this plan to avoid "why are you taking more later" friction. Widower facing the widow's penalty, last joint year push. Maria and Joe, both 67, Joe's health declines. Their advisor flags the last year they can file jointly. They fill the 24% bracket with conversions that year, fund taxes from taxable, and accept one IRMAA tier. After Joe passes, Maria files single and faces tighter brackets, but the pre-tax base is smaller and her RMDs and IRMAA exposure are lower. The kids inherit a larger Roth and a trimmed traditional. RSU heavy tech worker with conduit trust risk. A parent's conduit trust forces inherited IRA payouts annually because death occurred after the required beginning date. Their 35-year-old beneficiary has large RSU vests in years 2 and 5. Those forced payouts stack with RSUs, spiking tax and setting future IRMAA tiers. The fix would have been an accumulation trust with discretionary distributions and 65-day authority, plus directing more Roth to the trust. Lesson: draft for optionality when income is volatile. The thread through every case: align account type to the person's tax reality, then run a 10-year calendar that respects brackets, IRMAA, and state lines. Control lives in your setup, savings show up in their sequence. Execution checklist, the moves to make this quarter. Let's lock this in with a clear, do this now checklist so your plan actually works and your heirs get a 10-year runway that's tax-aware and calm. Inventory every account with precision. List balances by type. Traditional IRA/401K, Roth IRA/401K, HSA taxable brokerage. Next to each, add cost basis for taxable, current beneficiaries, custodian, and login. Note your state of residence and any likely move date. Why this matters: account type decides tax story, basis and beneficiaries decide flexibility, missing forms nuke options. Project brackets for the next 10 years, yours and theirs. Use a simple 2-column sheet per person, estimated AGI by year and your target top bracket ceiling for conversions or distributions. Layer in known events, retirement dates, Social Security start, first RMD year, widow's penalty risk, RSU schedules, business sale windows, sabbaticals, relocation timing, and Medicare start. You don't need perfection. Ranges beat guesses. Choose your Roth conversion ceiling. Pick a bracket you'll deliberately fill, often the top of 12%, 22%, or 24% if your heirs will face 32% plus. Build a one-page dashboard, projected AGI, chosen ceiling, next IRMAA tier with the 2-year look-back and state tax notes. Decide which IRMAA cliff you'll avoid and which you'll cross on purpose for a clear payoff. Fund taxes from cash or high-basis taxable assets so every converted dollar lands in Roth. Schedule 3 conversion windows. Put spring, fall, and market dip placeholders on the calendar. Execute in tranches so you can pause if other income spikes or markets surge. Add a note, run a mock return before each tranche, confirm bracket, IRMAA, and credit phaseouts. Fix beneficiary design now. Align pre-tax to lower tax heirs or charity. Tilt Roth to higher tax heirs. Keep brokerage as the flexible equalizer. If a trust is needed, use a properly drafted accumulation trust with discretionary distribution standards keyed to bracket, residency, and IRMAA, plus 65-day authority and separate shares. Use multiple IRAs to separate strategies, one IRA per heir or trust so each inherited account can run its own 10-year plan. Verify primaries, contingents, and per stirps. No account should default to estate. Add your charitable slice. If you're 70 and a half or older, schedule qualified charitable distributions to cover part or all of this year's RMD without lifting AGI. On the beneficiary form, name a charity or donor-advised fund for percentage of traditional IRAs. Keep Roth and stepped-up brokerage for family. If you want income to heirs plus a charitable remainder, book a consult on a testamentary charitable remainder trust funded with pre-tax dollars. Coordinate RMDs and AGI management. If you have RMDs, map what QCDs will cover and how much room remains for conversions inside your chosen bracket and under IRMAA. If you're pre-RMD with large pre-tax balances, consider strategic withdrawals this year to reduce the base and open more conversion room later. Add a reminder. Confirm year of death RMD obligations in beneficiary playbooks. Build a one-page 10-year map per heir. Include expected income, residency plans, Medicare status, bracket ceiling, the next IRMAA tier, and a default withdrawal cadence with pivot rules. Front-load in low-income years, accelerate after a move to a no-tax state, taper near IRMAA cliffs, and bunch income in 1 year rather than nicking multiple tiers. Add, never roll to your own IRA, title as inherited. Meet your drafting team together. Book a 60-minute joint review with your estate attorney and CPA. Agenda: convert target ceilings, IRMAA plan, trust language for accumulation and discretion, 65-day rule, separate share provisions, charitable carve-outs from pre-tax assets, and trustee or protector powers to adapt as tax rules evolve. Ask your CPA to sanity check state tax arbitrage if a move is likely. Set an annual fall review. Every October, refresh the bracket map, IRMAA tiers, residency timeline, RSU schedules, and withdrawal targets. Repull beneficiary forms after any life change. Note any guidance changes on inherited IRA distributions when death occurs after required beginning date and adjust the plan. Capture it in plain English. Write a legacy letter, why assets are split this way, the 10-year rule in one paragraph, each heir's map at a glance, IRMAA reminders, and who to call first. Clarity prevents costly equal but not after-tax equal disputes. Quick wins this week. Download and fix every beneficiary form, run a mock return with a $50,000 Roth conversion, schedule QCDs if eligible, open additional IRAs to separate beneficiaries, and set your joint attorney CPA meeting. Small moves now prevent big taxes later. Landmines to avoid so your plan actually works. Let's make sure a solid plan doesn't get wrecked by fixable mistakes. These are the landmines I see most often and what to do instead. Missing or stale beneficiary forms. The beneficiary form controls IRAs and 401(k)s, not your will. If a form is missing, names your estate, or lists an X, you can trigger probate, short payout options, and lose flexibility under the 10-year rule. Fix it this week. Confirm primaries and contingents on every account. Add per stirps if you want assets to flow down a child's line, and align forms with your trust and charitable plan. Using the estate as default. Pouring an IRA to the estate can accelerate timelines, invite creditor issues, and complicate taxes. It also blocks clean percentage splits to multiple heirs or charities. Name individuals, trusts, or charities directly on the form. The form wins every time. Conduit trust language after the Secure Act. Old conduit provisions force payouts in years 1 through 9 if death is after the required beginning date, then full depletion by year 10. That's rigidity, not planning. Update to a flexible accumulation trust with clear discretion to distribute based on each beneficiary's bracket, state, and Medicare status, plus 65-day authority and separate shares. Trust accumulation without governance. Retaining income by default often means paying top trust rates fast, plus state trust taxes. Write a distribution policy. Target low-income years for the beneficiary. Consider residency moves. Use the 65-day window in January-March and document the bracket you're aiming to fill. No separate shares and one inherited IRA for everyone. One account, 3 beneficiaries, 10 opinions. It's chaos. Create multiple IRAs now and name one beneficiary per account. Or ensure your trust has separate share provisions so each 10-year plan runs independently. Converting to Roth blind to IRMAA and state tax. Big conversions 2 years before Medicare can spike premiums. Converting in a high-tax state when a move to a no-tax state is imminent burns cash. Build a one-page grid, chosen bracket ceiling, next IRMAA tier, and residency plan. Decide which cliff you'll avoid and which you'll cross on purpose for a clear payoff. Withholding taxes from conversions. Withholding shrinks what lands in Roth, and before age 59.5, the withheld piece can be a penalized distribution. Fund the tax from cash or high-basis taxable assets so every converted dollar compounds tax-free. Giving Roth to low-tax heirs and traditional to high-tax heirs. It feels equal, but it's backward. Tilt Roth to the high earner, traditional to the lower earner or charity, and keep brokerage as your flexible equalizer. Document the after-tax logic so it's understood later. Ignoring the widow's penalty. After one spouse dies, the survivor files single and hits higher brackets sooner on the same income. Use the years between retirement and the first death and the final joint filing year to fill cheap brackets with conversions. Coordinate Social Security to keep AGI lower when converting. Trying to do QCDs from inherited IRAs. Beneficiaries can't. QCDs are only for the original owner age 70.5 or older. If you're charitable, use QCDs now to reduce AGI and RMDs and name a charity or donor-advised fund as a percentage beneficiary of your traditional IRA at death. Stacking capital gains and inherited IRA income in the same year. That can trigger the 3.8% net investment income tax and IRMAA tiers. Sequence gains into lighter IRA years, harvest losses when markets dip, and use Roth for spending in IRMAA-sensitive windows. Failing to retitle the account correctly. Non-spouse beneficiaries must title as an inherited IRA in the decedent's name for their benefit. Don't roll into your own IRA. Confirm the custodian processes it correctly and whether a year of death RMD is due. Year 10 procrastination. Waiting for the last year usually means bracket spikes, NIIT exposure, and IRMAA hits 2 years later. Build a year-by-year map now. Use tranches, pair withdrawals with deductions, and adjust each fall. No review cadence. RSUs shift, people move, RMD ages change, and guidance evolves. Put an annual October review on the calendar, refresh bracket maps, IRMAA tiers, residency timelines, and beneficiary forms. Small tweaks prevent big taxes. If you remember nothing else about landmines, remember this: the form, the titling, and the timing either create options or kill them. Get those 3 right and the rest of your plan can do its job. Keep more in the family on purpose. The big idea is simple. The Secure Act compressed your kids' timeline, so you decompress taxes with design, convert in your cheap brackets, aim pre-tax to low-tax heirs or charity, use flexible trusts, and run a 10-year withdrawal map. Want the advanced playbook and live examples? Watch my deep dive on Roth timing and the trust mistakes families still make, then subscribe for the full Trap series and updates as rules evolve. Your heirs will thank you quietly when their tax bill doesn't explode. Appendix, resource pointers, and prompts for you to act on. Let's finish with simple tools you can use this week. No rates on screen, tiers change, so use these checklists and prompts to build your own numbers. IRMAA and Medicare timing. Make a one-page grid with filing status down the left and blank lines for IRMAA thresholds across the top. Add a big note, 2-year lookback, 2025 income sets 2027 premiums. Circle your month turning 65 and your retirement month. Add, file SSA 44 if retirement, marriage, divorce, or spouse's death lowers income. Bracket guardrails. Create a page titled Ceiling and Cliffs. Lines for target top bracket this year, next year, and the year you start RMDs, NIIT awareness, state surtax notes, and a bold do not cross AGI line. Add reminders. Higher AGI can tax more Social Security, and capital gains stack on top of ordinary income. RMD and age checkpoints. Write these bullets. QCDs available at 70.5. RMD age under current law. Required beginning date concept for year of death checks. Add a box. Inherited IRA must be depleted by December 31 of year 10 unless eligible designated beneficiary rules apply. Trust language prompts for your attorney. Ask, does the trust allow accumulation with full discretionary distributions, or is it conduit only? Can the trustee consider beneficiary brackets, residency, and IRMAA when distributing? Are separate shares created? Is 65-day authority explicit? Are charitable carve-outs from pre-tax assets permitted? Do we name a trust protector to adapt standards as laws change? Beneficiary form checklist. For each account, confirm primaries and contingents per stirps where desired and that nothing defaults to estate. Note which IRA is earmarked to which heir or trust and any percentage to a charity or donor-advised fund. Add, review after marriage, divorce, births, deaths, or moves. Planning worksheet. Columns, account type, balance, basis, taxable only, custodian, owner state, likely move date, beneficiary, beneficiary state, beneficiary bracket band, Medicare status, preferred asset match, Roth, traditional, brokerage step up. Add 10 columns labeled year 110 to pencil a default withdrawal percent for inherited accounts. Conversion dashboard, 4 lines, projected AGI, chosen bracket ceiling, next IRMAA tier, conversion room. Add notes, appeal IRMAA if retirement, delay big conversions until no tax residency, execute in tranches, spring, fall, market dip. Withdrawal map for heirs. 1 page per person, expected income by year, residency plans, Medicare status, bracket ceiling, next IRMAA threshold, and default withdrawal cadence. Add rules, front load in low income years, accelerate after a move, bunch income in 1 year rather than nicking multiple tiers, and never roll an inherited IRA into your own. Annual review triggers, life events, retirement, relocation, marriage, divorce, births, deaths. Tax events, bracket changes, IRMAA tiers shifting, RMD age updates, new guidance on inherited IRAs. Market events, 10% dips or surges to time conversions or distributions. Action prompts, download every beneficiary form and fix gaps. Schedule QCDs if you're 70 a plus. Run a mock return with a $50,000 conversion. Open additional IRAs to separate beneficiaries. Book a joint meeting with your attorney and CPA. Write a 2-page legacy letter explaining the 10-year rule, each heir's map, and who to call first.